Hello. Welcome to this week's Traders Talk. And this is Ming Hon, your host for Traders Talk, and we have this show every Tuesday for aspiring traders and also experienced traders on the stock market. And we cover a lot of things during this show, and we specialize in speaking about the US stock market and also on options. So for those people who are familiar with us, we have been having this show for quite some time, and there are a lot of contents which we share during this show. So welcome for those who have just joined us. We will be starting in a short while, and today we are actually going to cover just a very general topic, which basically talks about are we close to the end, because this is our year end. uh, in 2 more weeks, we are actually going to close 2021. So how have we been doing in the stock market, and what should we do for the remaining 2 weeks, whether we should gear up or stand down. Gear up means basically to put on more positions, to catch any opportunities that exist, and of course to stand down would mean to actually look at the cost, whether it is actually okay or not to add on more positions for the year. And of course, if you have been following the markets, right? The following markets, it has been quite a volatile market in the past few weeks, with a lots of ups and downs. And if you look at the SPX, right? Uh, Yesterday was actually a quite a bad day, where SPX has actually, the S&P 500 has actually went down by 52 points, about 1%. In fact, during the day, it has even moved down more. If I could recall, almost about 80 to 90 points down. 80 to 90 points down. Yeah. Let's put up the slide, not slide. This. Okay. So, right. Oops. Let me pull this out. Okay, so this is the S&P 500 SPX, the index, right? So yesterday it actually closed, as I said, 52 points down, and in fact, it actually went to the lower of about 4529. Another about 80 over points down. During the day, and of course, it actually recovered towards the end of the day. And if you look at the retracements, right, this time round, the upswing post this period here, right, is actually not that strong, right? So this basically, the market actually went up, right, but it actually failed to break the previous high level, around 4730 level, around 4730. It actually uh, faced the resistance at about 4730 level, and actually it bounced back down. Bounced back down strongly. You see, this is actually 1 2 3 the last 3 days it has actually been coming down, and that basically took on a lot of I mean, if you are long in the market, right, that basically has wiped out a big chunk of your profits. I mean, this is only on the index, right? But of course, if you look at the component stocks in S&P. Yeah, even the strong one, which was actually backing the S&P earlier, right? Which was Apple, right? Apple could not withstand also the retracement, yeah. And then Apple has actually went down from its all-time high, right? Of about $182 here. Yeah, it has actually retraced from 182. It failed to actually reach the $3 trillion club. $3 trillion club. Yeah, it failed to actually go above to reach 3 trillion, and it has actually came down now to about 170. And this is actually the 20 simple moving average. 20 simple moving average for Apple. Yeah. And of course, I would love for Apple to actually even come down more to this level here, this support level here, which is actually at about 158. Yeah. And this 50 moving average. Yeah, if it comes down to this level, that would be some opportunities for us to actually um, put on some more positions. Yeah, whether you're actually doing spreads below 150, that is actually a good opportunity to work on some positions on Apple. Yeah, so hopefully it can continue to come down, but I do not think it will actually come down so much lah. I would think probably the level of about 165 would be another level of support at 165. Yeah, and if the market continue to come down, it might come to this level. But seeing SPX yesterday, right? I think it is going to rebound slightly. Even the futures, right? The futures for the ES futures today has actually also went up by about 30 over points, if not mistaken. Let's check. About 40 over points now, 43 points, yeah. So 43 points, S&P futures is actually up, yeah. So for those who have just joined us, welcome, 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 welcome. Yeah, for those who have actually just joined us. Okay, so the Nasdaq has also retraced yesterday. I mean, it actually gapped down. It actually gapped down for the past 2 days. I mean, it has actually gapped down, but during the intraday, it has actually recovered some of the positions. Yeah, that's why you see green candles here. But of course, these are actually coming to a lower price, and you can also see the price bouncing off the previous low, which is at 15545. Yeah, this was the previous low. It is actually now, it seems that it's actually bouncing off at this level, which is also around this level of support in the past. This was the previous resistance becoming support, right? This was also probably one level, yeah, which is now probably forming a support. Yeah, so this is one, this is another level. If it managed to go up above this level, then of course there are opportunities that we can see the Nasdaq also going up. But of course, Nasdaq this time round, it is actually facing the interest rate hikes challenges and all, because most Nasdaq stocks are actually on the tech side, right? So for tech sectors, it is actually a bit more sensitive to interest rate hikes because it will affect valuations. It will affect valuations. It will also affect cost of borrowings, because most of a lot of companies are actually borrowing money to actually expand, right? They have not been profitable yet. So these are the time when such kind of market changes or policies, right, would actually affect these sectors. But of course, if you look at the stronger stocks, right, I mean, Apple was one. Microsoft, of course, is another one, right? Which East, which has also retraced to a level of support here. Yeah, you see the previous support. Yeah, it looks similar, you see, that to the overall market, right? There was actually one dip here, and now there is another dip here, and from the previous dip here, I think when the initial Omicron thing came up, right? Uh, it actually retraced, and now another situation which is similar with the fears of the Omicron virus spreading throughout the US and rest of the world, then again it's actually putting pressure on the market, Yeah, but of course the opportunity for it to bounce again is actually there, and if the market goes up, then again it might see another run up like the previous round. For here is another $30 up, to reach again, try to actually capture again the all-time high, which is at the level of about 350, yeah, 350. Okay, so this is Microsoft and some of the other stocks. Facebook has also retraced quite a lot here. Yeah, retrace a lot, but it has not reached the previous low yet. Yeah, because the run up in the previous round was also quite strong, Yeah, so again, whether to put in more opportunities or stand down to look at how the situation goes, of course it depends to what your game plan is for the current year or also the next year. And of course, for people who actually um, have their portfolio perform quite well, and they want to actually see that close their books, basically close their books with a positive return, then of course you can relax a bit, relax a bit if you have actually got a very good return for the year. You can relax a bit and capture the profits and come back next year to actually get into new positions or start up the year fresh. Yeah, but of course, for those people who have actually lost back a lot to the market because the market for the start of the year was actually how to say, was actually quite slow. Yeah, for the start, when the market started, it was actually quite slow, and in between it actually rallied up all the way up to September, and all these problems and the retracement started to come again very strongly. September was not a good month. I think November there was some slight retracement, if I could recall, and of course December again. um, it is actually quite a volatile month for the stock market. Yeah. So of course, if you have lost back a lot of how to say, a lot of your gains in the market for the year, then of course it can be actually indifferent for you whether you continue to enter new positions based on opportunities that exist, or to how to say, to chill down, to chill down, um, uh, look at the whole market again, to actually have the balance of the 2 weeks to actually assess which sector or which stocks which has actually potential for you to actually go into next year. Yeah. So these are the two views which I have. I mean, which people might have, lah. I mean, based on their current situation, how they would actually want to play out the current year, and also how to start up the next year. Okay. Okay, so let's get back to the some of the stocks, right? I mean, if you have any questions which you actually want to ask, just post on the chat box. Just post on the chat box, and then I will actually try to address them as we go by. Okay, let's put up something here. Let's put up something here. Okay, so this is actually the heat map. Which basically shows what is hot and what is cold. Yeah. So this is actually a heat map which basically shows the stock position, whether it's actually up or down, and for various sectors. I mean, let's put Nasdaq here. Yeah, if you can actually see. Okay, actually, this is on Think or Swim. This is actually the heat map for the component stocks, say of for Nasdaq 100, which I'm actually showing you here. And my heat map is actually very peculiar, and I do not know how to actually set it up. Actually, if you guys know how to do this, let me know on the chat box. The green is not up, guys. Okay, because my settings here is a bit screwed. So let me show you what the green means. Let me put out this chat box first. Okay. Okay. If you look here, let's put this view. Okay. If you look down here, right? If you look down here, yeah, green is negative lah. Yeah, green is -8. Green is not up, for my, at least for my settings. And I'm not sure how to actually set this up. If you know, let me know. Green is negative, and then red is positive. Just for mine, I'm not sure what your settings are, but this is at least for mine. So today, if you look at the Nasdaq, right, Microsoft is down. I mean, this is pre-market lah, yeah, is down, and some of the stocks which are actually showing up is like Netflix, and then this is SML. What is this? The radar, it is that means the stronger the pre-market price. I mean, the price it is like, I mean, currently is pre-market, but of course when the market is trading already, this is reflecting the market price. So if you look at here, all the big boys here are actually not so good. The greener it is, the more it is actually going down. The redder it is, the higher the price is actually going up. So Netflix stay home stocks again was rallying since yesterday. I mean, Zoom initially had a big rally on the start of the market yesterday, but it dwindled down towards the middle or the end of the day. And if you look here, other stocks like Pepsi is up, Costco is okay. What else? I think these are only a few. Yeah, so this is a Nasdaq 100. So communication sector only Netflix, gaming EA, yeah, ATVI. This is consumer discretion is all not so good. Yeah. Booking.com, Starbucks went down yesterday. Today it is not moving much. I mean, based on the pre-market prices. Consumer staples, it is okay. I mean, consumer staples looks okay. Pepsi looks slightly close to 1%. Yeah, healthcare is actually the yesterday. Well, healthcare was actually up by a lot. If not mistaken, I see a lot of greens on the healthcare. And then industrial is not okay. This is information tech. Only this Broadcom is media, right? I mean, those media and all. I think COVID people watch more TV. I think. Yeah. Utilities. Here is nothing. Russell is too many companies to see. Here, this is Russell 2000 some more. Okay, S&P. Yeah, S&P. Yeah. So broadly, S&P you see today is still a lot of rates. Still a lot of rates. I mean, green is red lah. The other way around. Red is green, at least for me. Yeah. So Pfizer is up strongly. Healthcare, I mean, healthcare was actually up strongly. Even Moderna was actually up a lot yesterday, but it lost some of its momentum towards the end of the day. Yeah. Yeah. So this is actually the heat map. I mean, basically what I use this heat map to actually just gauge basically how the market is performing pre-market, just to have a feel how to actually set up positions, or how to actually manage those positions which I have on the stocks based on this information. So this is one thing which I actually use heat maps. Yeah. Okay, so let's go back to the charts. Okay, let's make it bigger. Okay, yesterday I was actually eyeing again on one stock, which I also covered last week. I mean, if you have followed us last week, uh, we were actually also talking about Starbucks. Yeah, Starbucks. Okay. Last week when I said that if Starbucks actually come down lower, right? I mean, it is actually an opportunity to actually put in some bullish position. In fact, uh, when it was actually down last week, I had already put in some positions, but of course it continued to actually come down. You see, it continued to actually come down. Yeah. And of course, yesterday it was actually down by only 54 cents. I thought it went down more. Yeah, maybe slightly more lah. Yeah. Okay. So today, if I look at the pre-market, no pre-market yet. Starbucks. Let's see. Starbucks. Okay, pre-market is actually up 84 cents. Yesterday it was down 54. So it is basically oversold position here. I mean, if you look at the stochastic, it's also below 20 here, right? Yeah, yeah, and then yeah. So again, for me, I actually monitoring this. I mean, if you look at Starbucks here, basically it has a lot of supports at this level of 108 here, right? At this 108 level. But of course, the last dip it had in this was in early November. It actually went down all the way to 103 to this level here. Yeah, to this level here, all the way down here to 103. Yeah. But at the moment, it seems that it is going back above lah. Yeah, because you can see these 2 days. This is actually just 2 days. It has actually retraced by quite a lot in just 2 days. Sold down. How much was it sold down? This was actually sold down just in 2 days. Is about 6%, 6% down. Is it? Just in 2 days, it was actually down by 6%. And of course, I'm not sure if the issues on the union. I mean, there are few stores which started to unionize for Starbucks, right? Whether those are, factors which has affected it. But for me, basically, I just continue to actually look at the chart patterns to decide how to actually put in positions on Starbucks. Yeah. So this Starbucks is something which I continue to actually keep an eye on. Yeah. I think earlier there were some puts, some naked puts, which I actually put at the level of even at 100. I think it was during either this retracement or this retracement. There were some naked puts here. Yeah. So I think it was this retracement. So basically, I did my favorite strategy, right? Which is actually the Super Bowl. Um, the Super Bowl is actually let's put back here. Yeah. So the Super Bowl is actually a naked put, which comprise uh, a naked put, a naked put, which finance, which I use to actually finance a bull call spread. Yeah, bull call spread. Yeah. So when you buy a bull call spread, basically you buy close to at the money or close to the current stock price, right? The a call, and then you sell a higher price call, yeah, to actually make the call cheaper lah, or your target price where you actually think that the stock would actually go, so you kept your profits there. And that is actually one level of financing for your call, yeah, to make your call cheaper. Okay. And of course, I add another level of financing to the call, which is basically through a naked put, through a naked put. And of course, this naked put would be naked put which is actually very far from the current stock price. So it's actually I basically look at how much I can actually generate value wise to finance the call spread lah, to finance the call spread. And basically most of the time when I do a call this type of structures, right, I would this is my personal preference lah, I would try to actually choose value wise probably about $1. That means the naked put would be priced at about around $1, depending on stock price also lah. But for Starbucks, I think I was actually picking up value at about $1, which is almost about 1% of the 1% of the stock price 1% of the stock price as my risk for the naked put. And then of course the bull call spread, basically you can actually structure it maybe about slightly above $1 plus. So when you actually mix this together, right, your cost of trade would probably run to even below $1. That means a bullish trade below $1, very cheap entry for a bullish trade. Yeah. So of course, when the stock rebounds very fast, right, that is where you can actually exit the position on the bull call spread, which was financed in the first place lah. Quickly lah. I mean, you just get a quick in and out for that. And of course, the naked put, depending. I mean, if the bounce was actually very high, very far up, then of course the naked put, sometimes I can continue to keep the position. I can continue to keep the position by only closing the what is that? Only closing the bull call spread. Yeah. So this is how I actually structure out stocks which has huge retracement. Huge retracement. Yeah. Starbucks is one of the one of my favorite stocks to actually put in this kind of strategy. Yeah. Super Bowl. Yeah. So I think I have also covered this in some past traders talk, right? Just go through the website and actually check out those sessions which I actually covered this Super Bowl strategy. And the other thing, maybe because a lot of people right now, right, is having how to say a lot of uncertainties, and a lot of their long positions are actually being threatened, right? They have a long position, maybe they are buying stock or they have a call, right? And the stock price continue to go down because the market is actually coming down, right? But they do not want to so-called close their position. Maybe it's a long-term investment for them, or maybe they think that the what is that, the retracement is temporary. But of course, within this period, I mean, if the stock continue to go down, right, you will continue to actually suffer a loss. So what are the ways for you to actually protect yourself from stock prices that you're long on getting down? So of course, one way is just to buy a put, right? Buy a put. But of course, buying a put is also not a cheap thing to do. I mean, if you're buying a put, depending on your stock price, you might be paying something maybe about 10 or 15% of the stock price, also depending on the duration, your cost to actually put that protection. And of course, if the protection is temporary, and if stock price rallies up, right? Rallies up after you have bought the put, then of course you will lose on the put. And yet the call movement, the improvement in your call or your stock might not be that much there. So what do you do if you want to actually have a protection, but not a very expensive protection? So what I do is, and also the timing. I mean, you might just want it for temporary, just in case the market continue to drop, you have some positive returns on the protection before the retracement comes, right? Before the retracement comes, but you don't want to pay so much. So what I do is actually a back ratio, yeah. So back ratio actually, let's see, let's put this up. Back ratio. Let's just show how to structure a back ratio. So what I do is actually do a back ratio, and how I do it is actually this. Let me put up the let's share this.
Did you eat the chocolate?
No, I didn't eat chocolate.
Then why are you laughing?
I didn't eat
Why are you laughing, huh?
Yeah.
Why are you laughing?
Okay, so back ratio. Let's do, okay. What is the stock which has actually gone down by a lot? Any of you want protection on which stock? Which stock do you want protection? If you let me know on the chat, then maybe we can actually show you one example which you are interested in protecting. Any stock you actually want to protect? No stocks. Wow, all all no need protection are also good or all is already shorting the market, all of you are already shorting the market. No stocks to that you want protection. Okay, let's see. Let's see. Let's see here. Wow, so many stocks here. Which stocks has actually gone down good? No, let's say maybe say you have very bad stocks. Okay, let's see SE gone down a lot. Okay, SE SE gone down from 368 till now 220. Yeah, 220. But of course, I think if you look at SE, maybe don't need so much protection SE. You can see here there are few level of support already at this level. Yeah. At about the 200 price. Yeah. Maybe SE don't need so much protection. Baidu, I think all the China stocks are all bottom, you see. This is also coming down to the previous low. One of the stocks which I did protection was actually this. I needed a lot of protection for this ETF. Okay. Oops. Okay. So what I did for this ETF, right, is if you look at this, this is actually KWEB, the China tech sector, right? Okay. It continue to actually drop, now it's actually all-time low, and of course positions entered was all the way from here all the way down. Yeah, so this was one of the stocks which I did a back ratio recently, and when I do a back ratio, right, I would actually pick a longer period to do. Yeah, mainly because of the nature of a back ratio. I would do at least 60 days. You can't do a short period, you actually need to do a long period, which I also show you why. Okay, so what back ratio comprise is actually technically is three legs lah. Yeah. Okay. What we do is actually we sell a put. We sell a put. Which is close to the current stock price. I would actually choose this at now. It's actually at about 37, right? So I'll do it at 38 here, 38. So I sell one put. Sell one put at 38, and for this put I basically collect about $3.30, $3.30. Okay, so 330 basically I would look for a price, right, which basically half of this 330. Yeah, so that would be about 165, right? So 165. So the closest I can actually do is maybe at here, 174. I buy two puts here. I buy two puts here. Okay, so I sell one put at the money, yeah, and then I buy two puts, which is half of the credit which I collected. Yeah, so this is actually the structure, and for this trade I only pay a 5 cent debit. You can even get a credit for it. You can even get a credit for it. And for this, we do analysis of the trade. We do an analysis of the trade. Let's make it bigger. Okay, we do analysis here. Analyze trade. You can't analyze trade. Enter a symbol. Okay? Can't you analyze trade? Variation. Trade. Analyze trade. Okay. Or here, risk profile. Yeah. Okay. Okay. So this is the risk profile. You need to actually check it when you run the trade. Okay. So this is actually the risk profile. Let me make it smaller. Okay. So for if the stock goes up, right? So if the stock goes up, you pay the debit, right? You pay a debit. Yeah. So you look at the purple line, right? You look at the purple line. So you pay a debit. If the stock goes up, here it shows that you will have a small loss of about, how to say, 17 or 18 depending on the time depending on the time. But of course, we will not keep this type of trades to maturity because of this issue here. Yeah, because eventually when time passes, right, this purple line will actually merge with the green line, right? Will merge with the green line, right? So of course, when it merge with the green line, right, when the price goes down, you will actually make a loss. You will actually make a loss. So we keep this trade with enough maturity that this purple line won't dip below this zero here, because once it dip below zero, you will start to actually make a loss and you will lose the protection. Yeah. So if the price actually goes down a lot, say for example, if the price goes down today, if the price goes down now it's actually $38, right? Yesterday I think it went down by $2. It went down by $2. So when it went down by $2, you will actually make a profit of here of about $30. If it goes down by $2, you'll make a profit of $30. So like yesterday, when I had this trade, of course the one which I entered was before the drop. It was actually maybe at this level. So when it dropped down, then I took some profits out. I mean, took maybe about 40 or 50. I think about about $50. I mean, profit when the stock price went down. I exited the trade with a $50 profit, even if the stock price is down, because I'm protected when it actually goes down. Yeah, it actually goes down. And if it goes up, I would not lose a lot also. Yeah, the value is actually very very small, you see, very small. But if it makes a huge drop, right, then that's where the protection will be bigger. Yeah, will be bigger. If it drops, let's say here, 37 dropped by say $5. Yeah, the profit is about $136. In fact, for this stock, right? In fact, for this stock, if you look at the price, right, it really dropped by a lot. One, it really dropped by a lot. Let's put here. In a week, right? Basically, this stock has actually dropped by how much? This stock has actually dropped in a week. Can I pull this up? Yeah, in a week. So this was one, 2, 3, 4, 5 days, right? So it was actually about $42 to now $37, 42.37. So basically that is about $5. So in a week, this stock has actually dropped by $5. And of course, if you look at the risk profile just now, right? A protection which costs you only debit of 5 cents, if it drop down by how much, $5, you will be protected to get the profit of about 130 over dollars here, 130 over dollars here. Yeah, so this is actually a back ratio. The bigger drop it is, the faster. I mean, the other one was which has huge drop in the recent weeks was actually Goldman Sachs. Goldman Sachs has probably dropped 20 over dollars within a short period of time. Goldman Sachs has actually dropped. This is 394, 371. Yeah, about 20 over dollars in just two days. Is it in just 2 days? Yeah. So again, stocks like this, the back ratio would actually work quite well. Quite well protection. Yeah, if it actually drops by a lot. Yeah, if you have a long position on stocks like this, and if you want a bit of protection, yeah, then this is the kind of trade we should do. But the buying power would probably be a bit higher. Yeah. For this trade, you will need to have a buying power of about $400, and this is actually on $400. Yeah, and this is actually on the stock of 40 over dollars. If you do one on Goldman Sachs, how much does it cost? Let's see. 18 February, if you can structure out one. So this is $17, $17, and then you take half of 17. My math's very bad. Half of 17 is how much? Yeah, half of 17 is how much? 8, right? 845 is okay. So 845 take 2, 845, which is at 340. 340, yeah. You see, you even get $1.40 credit, 140 credit. Let's analyze trade. Let's analyze trade. Here. Yeah. So if stock price goes up, you will make a gain. If stock price goes down, you will make a profit. And how much you go down? So this is actually $10 down, right? Let's see. So plus 10%, $31, minus 10%, $460. So if the stock drop down by 10%, you're protected by $460, which 10% of 300, and how much is the stock price? The stock price is 37 something, right? 374. Yeah, 10% is a lot lah to drop lah. Yeah, but it also dropped by 20 ma. Yeah, it also dropped by 20 ma, almost about 6 or 7% down already. So 6 or 7% down, you also have a protection of $200. Yeah, so not a lot. But of course, you can you can add on not one but two or three trades in this. If you need a higher protection, you do more. But please be very careful on this kind of trade. Don't let this purple line drop uh, below here. Yeah, and you need to actually close the position if you still want to have this protection. Close the current one, do a fresh one. Maybe earlier you were doing February, then you do a one in March. You do a one in March. Yep. Yep. So that is just some form of chip protection, chip protection which you can actually do. Of course, there are other ones which you can do, like bear. What is that? Barefoot spread. Barefoot spread is also one chip protection you can actually do. But of course, you need the cost is actually higher, and you need the price to actually move down fast, which you don't want, lah. Yeah, because you already have a long position. You don't want to actually, you are protecting your long positions. You are not actually entering into a directional position because you want to short the stocks, right? Yeah. So that defeats the purpose, lah. I mean, to actually do what is that? A bear put spread, right? Bear put spread. Yeah. The bear put, if you don't go, then of course you will lose money there, and then the other side also you were losing money, so you do not want to lose more money. So just do a very cheap protection, but watch out for the trade analysis. Make sure you look at the trade analysis, analyze it. The time is okay. Keep the period long enough, 60 days in the minimum, and watch the value that it does, the what is that, the P&L line. It does not drop below zero. Close the trade or roll the trade to the next one if you still need that protection. Yeah. So that is what back ratio is, lah. I mean, of course, the other side of it, you can also do a callback ratio. Yeah, it's a similar concept, but of course the direction is the other way. If you feel that the stock would actually gap up or go very, very, how to say, go up a lot, right? Then you can actually do a callback ratio. In fact, the callback ratio, we use VIX to do it. VIX, yeah, VIX, yeah. So when that is actually also a protection, because when the market drop, right? When the market drop, we do a callback ratio to protect our portfolio. Yeah, but the callback ratio is actually very, very expensive. Very expensive for VIX, at least for VIX. Yeah, the buying power is actually a lot. Yeah. Okay, so I mean, that's how it is, lah. I mean, basically, for the current volatile market, if for me, if I have already got a lot of gains, I would take things slower for the last 2 weeks, because you do not want a very bad, bad market day to actually take a lot of profit off your portfolio. And of course, if you are already affected, then try to actually look for uh, more opportunity for you to actually recover. If not this year, basically put on positions for you to actually make a recovery early part of the year. Yeah, because if the market rebounds from here, right? If the market rebounds from here, and of course, if the Santa Claus rally really comes towards the last 5 days of the year, and the first 2 days of next year, then of course, if you have put on the bullish trades within these 1 or 2 weeks, then of course that will give you a head start next year. So these are the two plays which you can actually see how to manage your portfolio, and I hope that you guys can continue to actually close the year with a very positive return despite a volatile market. And if you need protection, the things which I explained just now, hopefully it can actually give you a slight protection in case you actually need it. Yeah. So okay, all right. So I think that's all for today. And if you have any questions, put on the chat box. I can actually answer that before we close. And if not, hope that today the market continue to rebound and rally up, and hope to get more profits and close the year with still a positive return for everybody. Yeah. So 2 more weeks till the end. I will catch up with you probably next week. Next week I will do some again, strategic planning, some information on planning ahead for next year. What are the things which we actually should look out for and plan ahead, and probably which are the sectors. Maybe we can also talk on sectors. Which are the sectors which we can focus a bit more for next year, and that we will cover in the next show. Yeah. So okay, all right. Thanks, Sharon, for joining us, and I will see you guys next week. Yeah. So I'll see you then. Yeah. Bye bye.